Okay, so let's talk stock market panic because this is what we are seeing right now. Holy cow. All right, so let's talk about what we're seeing. So Wednesday, the market went down 831 points. Today, it went down 545 points. So the combination of the two, it's a good chunk. You are talking about 1,300, yeah, a little over 1,300 points, so 13.7. So that is causing a lot of people to think that this is like a stock market crash, this is a recession, this is a lot of people are trying to say it's an '08 all over again. No, it's not a stock market crash. No, it's not a recession. And no, this is not an '08 financial crisis. Okay. Let me just put that out there. So it is none of those things. Okay. Right now, there is a lot of volatility because there's a lot of people trading on information they don't know how to interpret. So let me explain that. So in the last couple of videos, we talked about the Federal Reserve, increasing the interest rate. That is what people are panicking about. Why they're panicking about it is because they don't understand it. Okay. So let me explain, um, how this is tied to the stock market. So there's a reason why I kept talking about the Federal Reserve and the interest rate hike, because it has huge implications on the economy. But the stock market right now, the people that are trading in it, that are individual investors, they don't understand how to quite interpret the information correctly. And so now there's all this undue fear and panic. So the Federal Reserve has come out. I told you Powell's been pretty aggressive about moving the interest rates. And he has not tried to hide this fact. He has not, been devious in any way. He has been upfront and forthright about what his intentions are with the interest rates. And so the inflation information has, been coming up as of late. And if you remember, if inflation is the fancy economic term of saying increase in prices, okay? So if the inflation rate is going up, then it's anticipated that the Federal Reserve will respond in kind and increase the interest rate, okay? Because again, their only mandate is to stabilize the US economy. And inflation is one of those things that they watch. So if inflation goes up, they're going to move that Federal Reserve rate to go ahead and counteract inflation to some degree. So again, this is not new news. This is Powell's been very clear on his directives of what his intentions are for the interest rate. So inflation information has been coming in, and people are like, "Oh my gosh, inflation's still going up." Then the Feds are going to move the interest rate up. And if you remember in my last video, if they move the interest rate up, that tightens credit, meaning people are going to be less likely to borrow because the borrowing cost is too high. The interest rate that you're going to have to pay on, a loan is going to be too high. And that includes businesses. They won't borrow. And so if they don't borrow, then, several things can happen. I'm not going to touch up on all of them because there are too many. But, a couple of things that could happen would be, they might have to go into their cash reserves into funding their projects, or they might cut down on R&D or funding new projects that could possibly, provide new revenue, because they're going to go into cost saving mode since they're going to be limited on cash flow. They're going to be going into cost saving mode to make sure their profit line looks good. So if they do that, then people are like, well, then the profits might not be as good, and so they're what's called forward looking, and they're looking into the future to anticipate what these interest rate movements will do to the economy and to companies' profit lines in the future. So they're like, okay, if interest rates go up, they're going to run into, cash flow issues because, they are not going to want to borrow. And so it can impact a whole bunch of different areas of their business. And so their stock price goes down because people are like, I'm going to sell now and get the higher stock price while it's still up higher. And then I'll just sell it now. And it's what's called profit taking. And this is how really you should be doing it. Okay, you should be selling when the markets are high. The problem is that people are panicking like the Federal Reserve moving the interest rate is new news. Like they're like, where did this come from? What do you mean you're going to raise the interest rate? He's been saying that since he got into office, since he's been appointed as the chair. And so this is irrational fear that we are seeing. And again, this is where individual investors are not quite understanding the information that they're seeing and they're not interpreting it correctly, which is why it's causing this mass panic sell. And so that's what's happening here. Okay. And stock prices are falling the big, swings downward in price. The reason we're seeing that is there's zero economic data that supports this type of movement. Zero. So what's happening, let me explain, is that you've got individual investors that are selling. And then you get algorithms that come into the picture, okay? So you have individuals that are selling, but then you have these very sophisticated, sophisticated computer systems that are designed to help people know when they should sell and also will sell automatically if certain parameters are hit. So when individuals start selling and they sell in quite large volumes, then these algorithms get triggered to sell. And so then they sell, and then the price gets pushed down even more, and then more individual investors sell because the prices keep going lower, and it just spirals downward into this downward trend. So that's there's a lot of different moving parts to this, but these are some of the moving parts as to why you're seeing what you're seeing with the market. So this is, let me put some fears to rest here. There's, again, zero economic data that supports this type of movement. Okay, if we have inflation and not, crazy high inflation, but inflation that's within reason, which is what we have, that's a good thing. That means the U.S. economy is strong. And so this is not a bad thing that they're going to raise the rates. It makes borrowing costs more expensive, but that helps to kind of level out the economy so that it doesn't overexpand too much, or else we get other problems from having overexpand. So again, the mandate of the Federal Reserve is just to keep the economy stable, and that is what they're working on. And so you have that going on, and then if you didn't notice, so let me just side note here. So yesterday, about a half an hour before the market closed, it was down at like 750. Okay, 750 points on the Dow, and within 10, 20 seconds, it went back up to 713, and then it dropped again. The reason you see all these spikes is because the individual investors and these algorithms are causing all this sell action to happen. And the institutional investors are watching this. And when it goes down, man, they are just coming in and just swooping up and buying up a whole bunch of shares at a cheaper price. So maybe you guys weren't aware of this, but earlier today, so at the very beginning of the day, of the trading day, the market was up. And the market was up because the institutional investors came in and they poured money in, and individual investors as well, because it's cheap. Why wouldn't you be buying? And so, and then you had other individual investors, again, that cycle where they sold, algorithms got triggered, they sold, and then more individual investors sold and, saw it and they sold, and just downward spiral again. So again, there's no data to support this type of movement, but you've got the media that is just, trying to spread fear like freaking Halloween candy, and people are eating it up like Halloween candy. So, in one of the news outlets yesterday, they were talking about how the fear index, and yes, there is a fear index, the fear index hasn't seen these numbers since April of this year, earlier this year. And people are like, oh, this is really bad. Really? Because if you look at how the market has performed since April, what has it done? It's done pretty darn well. So why would you try to look at the past to predict the future? Okay, this is the bloody disclosure that every investment company makes, which is past performance is not a prediction of the future. So why are they saying, oh, well, this was bad as April of earlier this year? Okay, well, if you really want to base it on the past, then you look at from April till now and see how the market has done. It's done very well. So don't panic. This is not, end of the world. Yes, we've lost, quite a bit of points on the Dow, and well, in all the indices, but that's okay. This is to be anticipated, okay? And what I mean by that, it's okay and it's meant to be anticipated. It's the stock market is like a workout, okay? When you work out and you work out really hard, you need to take a break sometimes, even if it's just for short minute. You need to take a break, and then once you've had that break, you have renewed energy and you can push, through to the rest of your workout with a little extra oomph. That's what the stock market is like right now. It's taking a breather because what will happen is as the markets keep going back up, it's going to be more sustainable because we've had this kind of, um, a break. And so this is not a bad thing. And if you were looking for a sign to buy, boy, I don't know what else is it other than losing 1,300 and was it? Yeah, 1,370 points on the Dow in the last 2 days. So, I'm a big, big fan of Warren Buffett. And, he said something that I love because it's just so simplistic, but it puts the right idea in such eloquent words. So he says, be fearful when people are greedy and be greedy when people are fearful. What do you think people are like right now? Do you think they're being greedy or do you think they're being fearful? Okay, obviously they're being very fearful. And so don't buy into this rhetoric, don't buy into the news media, and definitely don't buy into the news media, okay? I mean, just to give you an example of how bad this was, of how bad that they can get. At the end of 2015, beginning of 2016, the media was having just a field day on the fact that there was this oil glut and what that meant for the global economy. And they were just spreading fear around, again, like Halloween candy. And again, people were gobbling it up, and the markets were having huge downturns. And in the third week of January of every year, okay, the World Economic Forum convenes in Davos, Switzerland. We are talking, these are the top economists, the top minds come together for a large conference. It's like 3 to 4 days, and they talk about everything that affects the global economy and individual economies. I mean, everything. It's fantastic. Anyways, they ended up basically coming out against the media during their conference and telling the media, like, quit spreading this fear. We're still analyzing the data. If we're analyzing the data, there's no way you know more about this than we do. So we're not making any opinions at this point. Stop talking about it. And I'm not kidding you. The media stopped and it started ticking back up. So it's amazing how powerful they are at spreading fear around. And the reason they do that is because of ratings. You are more likely to believe bad news over good news. You're more likely to believe that somebody lost $100 than if somebody found $100. And so it's hard not to get caught up in this right now when you're hearing it, and especially if you're being inundated with it, through all the different media channels. But don't pay attention to it. They love to feed on your fear because whether you want to admit it or not, you are emotionally connected to your money. And so And because you're emotionally connected to your money, statistically, you are going to make the wrong move at the wrong time because you won't make rational decisions. You're going to make emotional decisions about your money. So right now, a lot of people are like, they view the stock market kind of like Vegas, okay, which is really stupid because it is not. There's a lot of data and analysis that goes into investing, but a lot of people view it like Vegas. So what I mean by that is when the markets are riding high, they're like, it's like they're on a winning streak, right? They're on a really good hot streak. And so they're like, oh, let the good times roll. Just keep riding that out. No, actually, you shouldn't. When the markets are high, that's when you should be selling because the whole point of investing is to buy low and sell high. But what most individual investors do is they will sell sell low and buy high. So when the markets are having a downturn like this, again, they treat it like Vegas and they're like, oh, I should walk away and cut my losses. And they're like, I'm going to stop the bleeding. No, what you've done when you sold is now you've hemorrhaged yourself. You are preventing yourself from being able to have that market price go down and then come back up because you've decided to sell right here at the lowest point. And so this is what's called a paper loss, meaning, yes, on paper, the account value is doing this, going up and down, okay? And when it's going down, it's just on paper. You haven't sold anything, so it's not locked in. So when the market starts coming up, you get to ride that price back up. But once you sell at this point, you've locked in your losses. You don't get to be able to ride that back up when the markets are going up because you've sold out of it. So a lot of people are like, oh, I've stopped the bleeding and sold, and usually it's at the lowest point. Believe it or not, it's amazing. We are really good at picking at the wrong time to sell. And so they'll sell at a really low point and they've caused a hemorrhage instead of stopping the bleeding. So if you really want to stop the bleeding, just don't pay attention to the media. Don't look at your account balance right now. It's one of those times where ignorance is bliss. Go look, up something frivolous and, superficial. Okay, go read about a celebrity. Go watch sports. Go do something, anything, but looking at the news outlets for information about what's happening in the markets. Because right now it is just fear, 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 and it is unfortunately working. But this will subside. Eventually, it'll subside. As to how long it'll take, it depends on how quickly people realize that this is, again, there's no economic data to, support this type of movement. Now, a lot of people are like, oh, well, what about the, trade war with China? Again, there's no trade war here. There's basically a war of the vanities right now. It's basically just a hissy fit, but China can't afford a trade war right now. Economically, they really can't. They've got too many issues that are actually preventing them from going into something like that. And so it's just a hissy fit. So that wouldn't even justify this type of movement. So again, there's zero data that supports this type of market panic, but it's just irrational fear from humans. Because again, whether you want to admit it or not, you are emotionally connected to your money. So just breathe. You're fine. And I hope this helped. And if you have any questions, let me know. I am more than happy to answer them. And we'll talk about some other topics in the future. I just wanted to touch up on the stock market because it's obviously had some big movements in the last couple of days. But I just wanted to put some fears to rest for you guys so that you don't make the wrong move at the wrong time. So, all right. Talk with you guys later.